Yo guys, welcome back to Stock Talk Insider. Today I will be talking about Fubo TV, one of the more much talked about stocks that would maybe give very big gains over the coming years. Going right into the information. Thanks for the support on the last videos, by the way. So yeah, having said that, let's get right into actually the information I wanted to give you guys. So it's a sports-first streaming platform that's been making major headlines with the recent merger with Hulu Live TV and Disney's involvement. Fubo has gone from being a niche underdog to a serious contender in the streaming wars. In this video, we'll cover the company's background, growth potential, the risks you should be aware of, and most importantly, a realistic stock price target for June 2026. So stick around because this could be one of the most interesting media plays of the next few years. Going to the information about what Fubo actually is. Well, let's start with the basics. Fubo is launched in 2015 as a sports-only streaming service, and over the years it has evolved into a full live TV platform offering not only sports but also news and entertainment. Today it operates in North America and has been expanding into markets like Canada, Spain, France, and some other countries. It makes Fubo unique. What makes Fubo unique is its focus on sports, which is one of the stickiest and most valuable types of content in streaming and actually just in the world. So yeah, giving a background of its reputation, Fubo went public in 2020 through a SPAC merger, and while its stock has been volatile, the platform itself has built strong reputation. In fact, Fubo has been ranked number 1 in customer satisfaction, which is a big one among live TV streaming services. So while the stock chart has been a roller coaster, as you see on the screen, the product continues to prove itself with users and all of the customers it already has. So yeah. We also have a very big deal with Disney and Hulu. So yeah, going straight into that is now here's where things get really exciting. In early 2025, Fubo announced a major merger with Disney's Hulu Live TV business, which gave the stock a very big upside in 25. So as you see, this is all before the announcement of Hulu Live TV. So here you see that the stock jumped up to around $5, which was a very big increase in price, and a lot of people made a lot of money, of course. This instantly made Fubo the second largest online pay TV provider in North America, with over 6 million combined subscribers and roughly $6 billion in annual revenue. On top of that, Disney provided $220 million in cash and $145 million loan guaranteed to support Fubo's balance sheet. That huge financial backing and credibility for a company that until recently was still considered a small player. A very big why this is a game changer is because this deal doesn't just add scale, it also ends Fubo's legal battle with Disney, Fox and Warner Bros. Discovery, which means less uncertainty and better cooperation with all content providers. It gives Fubo more negotiation power, more pricing flexibility and broader content library, but put simply, this changes the trajectory of the company and makes it all a little bit smoother. So what are the main growth drivers going forward for Fubo? We actually have 4. It's sport dominance. Fubo's core strength is sports streaming, and that's one of the biggest competitive advantages is in media. The subscriber growth. The merger instantly boosted its base, and more subscribers mean more advertising and upselling opportunities. Pricing power. Fubo recently raised subscription prices, proving customers are willing to pay more for premium content. The brand positioning is the 4th one. With Disney's support, Fubo is no longer just a niche brand, as said before, it's a credible, large-scale competitor. So, having all said that, we also have the risks and challenges, of course, something you have to take care of, just as your positive things, of course. So, no stock is risk-free. The big challenges for Fubo are content costs, especially sports rights, which are extremely expensive. So Fubo has to pay for their sport rights so they can stream their content. Strong competition from Netflix, YouTube TV and traditional cable companies, which are already very big, of course, and macroeconomic pressures, inflation and tighter budgets could impact consumer spending on streaming. But with Disney now in the mix, many of these risks are at least partly reduced but not gone. So where could the stock go from here is the big question, of course. Right now Fubo trades at around $3.70 per share. Wall Street's average 12-month target is above $5.50, which would be a 50% upside from today's prices. But looking further ahead, considering the Hulu deal, subscriber growth and stronger balance sheet, a realistic target for June 2026, which is where I put my prediction, is around $6 per share, which is very possible if the company keeps doing what they're doing. That's about 6% upside, which is a very nice thing. In less than 2 years, not life-changing, but very strong considering how beaten down the stock has been. To wrap it all up, Fubo TV has transformed from a niche underdog into a serious player. The Hulu plus Live TV merger massively expands its scale. Disney's backing provides financial strength and credibility, and the stock has a realistic path to $6 by mid-2026. For investors looking at the future of streaming and sports, Fubo is definitely worth watching. So, if you found this video very meaningful, and you maybe had something that you could use from this video, then leave a like and subscribe to the channel if you want more of this, and I'll see you guys later.